The essence of using stop loss in Forex trading. My name is Oyewole Olatunbosun. I hope you're going to have a very wonderful moment with me. Let's go straight to the business. I read this quote that if you do not use stops, it is not a question of whether you will go broke, but a question of when. This means a trader who is not using stop loss will definitely go broke one day, meaning that your account is going to be blown up as a result of that poor practice. So I call non-use of stop loss a poor practice or poor trading system. Practice. Right. So you can see that it's not only black swan events that can lead to fatal losses in trading. The use of leverage in Forex can increase losses. The larger the leverage, the larger the potential risk. Okay, so the closer you are to margin call. Prices in the Forex market do not move without retracement. When you are trading in a trending market, you expect minor retracement. But what if minor retracement suddenly changes to a major retracement and you are not using stop loss? What do you do? You know, something that is very funny about the market is that when a trade is moving, when price chooses to move against you, it does that so fast, so quick, and so large. So a stop loss order essentially limits the loss on a position. It does not eliminate the loss. Stop loss does not eliminate the loss. It just reduces it. Some traders think that they can watch prices by babysitting and place order to exit their trade, their negative trade, using mental stop. What I mean by mental stop, it means you manually close a trade, a bad trade. It means you manually close a bad trade without stop loss. But in practice, it is very hard to exit on mental stops. Why? You will be overwhelmed with thoughts that the price will return in your favor, and this is called "if you come back" syndrome. If you come back disease, and it may never come back until you have lost all your money. So your ego may rear up its ugly head also at times, and you continue to argue the market that you know perfectly well that what is causing the reversal against your position, you know it, so that the price will soon resume. In your judgment, you said the reversal is not justified, but the market is not interested in your judgment. The market may be completely irrational and wrong, but you need to remember that the purpose of your trading is not to be right, it is to make money. You may have reasons that seem like rational thinking, but in reality, you are making excuses for emotional trading if you are not using stop losses. Another reason some traders give for not using a stop is that the brokers will know where they place their stop and go hunting for it. While this may be true, to experience sudden and catastrophic losses is worse than being outsmarted by the brokers in few number of trades. You just have to choose. It is true that brokers and others do hunt for stops in the effort to force your exit so they can buy more cheaply or sell more dearly a little later. But realistically, no one needs to know your exact stop loss level. Stops are placed at any of a limited number of technically logical places, including support and resistance lines, Bollinger Bands, and Fibonacci levels, and so on. So anyone with a chart can see where stops must be clustered. When the market decides to go against you, the wise thing to do is to get out of the way instantly. And this is only easy when you are using stop loss. My friend, don't tell me you use mental stop. Mental stop is the hardest practice, the most difficult. You are trading the hard way if you are not using stop loss. The major reason we use stop loss order is to satisfy the conditions for a good trading plan. In a good trading plan, you predetermine what your reward risk ratio is likely to be. You must not be down to the last cent because you are trading. You must not blow your account because you are trading. Let's say you want to make $20 for every $10 you risk. The only way to achieve that goal is if you are using stop loss. So you only need a system that is 50% efficient, and you'll be making profitable results in the long run with $20 reward versus $10 risk. But you cannot run a viable reward risk ratio trading if you are not using stop loss. We know that stop loss have drawbacks. Okay, one of it is the gap or big move that happens so fast that your stop loss order does not get filled and the level you specify at the level you specify. Okay, maybe your stop loss order is 50 pips and market moves so fast that it now go to like 80 pips or even 100 pips. Okay, at the far worst level, and then after you got stopped out, the price turns around and returns to its previous level or returns to its previous direction, but you are out already. This is painful. It's usually painful, it's usually annoying, but one of the facts of active trading that you have to swallow is that. So to complain about getting stopped out on a temporary shock is not enough to abandon the use of stop loss. You can imagine if you do not use the stop loss, the move could have continued and wipe out your account. Another drawback is that you get stopped repeatedly on pullbacks. This is most of the time due to too tight stop loss. When you're using too tight stop loss, you are bound to get stopped repeatedly on retracement, because you must know that there is no market without retracement. No matter how trending the market is, it will surely be accompanied by what? A retracement. So when your stop loss does not respect retracement, then you are bound to be stopped out repeatedly. Finally, you may think the solution to not placing your stops is to have a mental stop and a system of alert on your PC. I'm telling you, this may not work, because your child may have an accident and you may have to rush him to the clinic, or any other accident just happens, or the electrical power goes out. I hope you have agreed that if any of this happens, you will have to abandon your babysitting, and that means your mental stop policy or mental stop strategy has failed. So it is easier and wiser to just set the stop when you place the trade, to avoid being caught unaware by the sudden move of the market during a bad trade. So thanks for watching, and I hope you have already had a wonderful time with me. Please don't forget to subscribe to my channel before you go. I also celebrate your comments. Finally, please check my useful links on the description page of this video. Once again, thank you. See you in my next video.